Hey Bowtie Nation, Joseph Hogue here, and the only thing we like better than dividend stocks here on the channel are the ones that keep putting more money in your pocket. Stocks that regularly increase their dividend payments every single year. In fact, the 7 stocks I'll show you today have increased their dividends by an average 700% over the last 5 years, and the top dividend stock has boosted its dividend by 1,600%. In this video, I'll show you how to find the dividend-paying stocks increasing their payouts. 3 criteria to find dividends that pay you more every year. I'll then rank the best dividend stocks for more cash increases. Stick around though, because towards the end of the video, I'll also share a warning you need to hear about these and really any dividend investment right now. 3 signals that those dividend increases could be coming to an end. We're getting started, but before we do, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and the trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for the sign up link below. I want to get started on that list of top dividend stocks, so I'm going to wait to show you how I found these and those 3 warning signs later in the video. First on our list, with a 3.6% dividend yield, shares of Citigroup, ticker C, doubling its dividend over the last 5 years. And now I know for all you die-hard dividend investors out there, 3.6% might not be enough to trip your trigger, but imagine investing in shares of Citigroup just 6 years ago in 2016 at $41 each. The shares back then paid a dividend of just 20 cents a year. Now that dividend has now grown to over $2.04 a year, nearly a 5% yield on your investment. That's the power of these dividend growers. At that rate, they're growing their payouts. Invest now, and you're going to see that yield rise every single year. With Citigroup, not only do you get that strong dividend growth, but it's also one of the lowest valuation stocks in my favorite industry right now. Historically low interest rates meant that weak net interest income last year for the banks, but that should change this year. Interest rates on everything from consumer loans to mortgages have shot higher, and that could mean a profit bonanza for the banks. Citigroup is also the 2nd large credit card issuer in the United States and could benefit on higher balances this year. With everyone locked down and getting that free stimulus money, people just paid off their credit cards, and the average balance on cards last year was still below 2019 levels. So you've got those 2 big catalysts for growing revenue at Citigroup, and the shares trade at one of the lowest multiples among the banks. The stock is trading for just 0.59 times on that price to book value, compared to a multiple of 1.1 times for Wells Fargo and 1.4 times for Bank of America. Even if shares of Citigroup can get up to their longer term average, that's right around 0.8 times their book value, that would be a 35% return on top of the dividend. Besides that upside potential on the valuation, Citigroup has been the bank you look to for those dividend increases, raising its payout from 16 cents to 51 cents a share over the last 5 years. Now that's an increase of nearly 219% over the period. Next is Medifast, ticker MED, a leader in the health and personal coaching field with a 3.6% dividend yield. Now a lot of these health and wellness companies have been under pressure over the last 2 years as people stay home and care really less about their health, but Medifast has still been able to grow its share price by 88% over that period. The company is estimating a U.S. market alone of $95 million for its meal plans and coaching, and books more than 90% of its revenue from subscriptions. Now, I love that recurring revenue model because it's going to lead to that consistent growth and cash flow. Revenue has grown at a 50% annual rate in the 4 years through 2021, with $120 million returned to investors through its dividend and that share repurchase program. Over the last 6 years, the company has returned 83% of its cumulative cash flow to investors, nearly $330 million. The company is aggressively expanding its coaching model into more states and even internationally, reaching Hong Kong and Singapore last year. That international growth opens up a lot of new markets and could keep revenue growing. Healthcare is one of my favorite long-term industries, and Medifast has proven it with a 343% increase in its dividend over the last 5 years. That's from an already solid 32 cents a share dividend to paying $1.42 a share on a quarterly basis. We've still got 5 stocks of growing dividends to highlight, but I want to take you through that screener that I used to find these and then how to build your own list of dividend stocks. I'll be using the stock screener on Morningstar, but you can find similar criteria on almost any investing app. I'll start by screening for stocks that pay a dividend yield of at least 3% or more because honestly, if it's not paying at least that much, it's not much of a dividend stock. In fact, the lowest yield in our list is 3.5% dividend. I then narrowed this list for 5-year dividend growth, and I used the long term here because I want to find companies consistently growing their dividend payment over that time, not just the big increases over the last year or two. So I set this for stocks that have grown their dividend by at least a 30% annualized rate over that period. Actually, I started with 25% and then increased it when I saw there was still 156 companies that met that criteria. That's something you're going to want to play around with here, adding a few criteria to narrow down your list maybe to 10 or 20 to start your research. I then added this criteria for companies over $500 million market cap, so I was only looking for the larger companies instead of that volatility in penny stocks. And it's from this short list that you want to start your research. I then removed any stocks that weren't paying a dividend 5 years ago and any with those volatile payments, so we could only focus on those consistent dividend growing stocks. Southern Copper, ticker SCCO, pays a 5.4% dividend yield and is actually one we recently highlighted in a video on electric vehicles. While most investors are busy watching shares of Tesla and NIO for that electric revolution, the real opportunity could be in copper. On 2040 projections, the International Energy Agency estimates supplies of lithium, copper, and other minerals going to need to jump by 30-fold to meet demand. The average vehicle on the streets today holds just 51 pounds of copper, less than a third the amount needed for a battery electric vehicle, and just 2/3 the need for a hybrid one. This chart shows the current and planned production for 3 key elements in electric vehicles. Dark blue here is the current operating production, with light blue including planned projects. Now on that red line, the increased demand from EV, we could see a supply deficit by 2024 in copper and even earlier in some of these others. Southern Copper has the highest copper reserves in the industry at over 67 million metric tons, and it's the world's 5th largest producer. In fact, on those reserves, the company has more than 50 years of production left in its mines. This is a focused producer with assets in Mexico and Peru and more of a pure play on copper than some of the other miners you'll see, with 84% of its revenue from the metal. With the rising copper prices, I'd expect Southern Copper to keep increasing its dividend, already up over 730% from 12 cents a share to $1 a share over the last 5 years. You don't hear much about the Chemours company, ticker CC, but it is one of the fastest dividend growers in the industrial sector. The $4.9 billion company is a leader in specialty chemicals, mostly in industrial applications and manufacturing. Just over half of the revenue comes from titanium dioxide, which is used in everything from paints to food coloring and sunscreen, so pretty much everything. It's really well diversified geographically, with sales split globally. Beyond this, Chemours is tapping into some real mega trends like climate impact and electrification with its Opteon refrigerants that could fuel sales growth beyond the 27% rate it posted last year. This is another value play, trading at a price of just 0.7 times the company's annual sales. That's 38% below the 5-year average multiple of about 0.97 price to sales ratio. If the global economy doesn't just fall apart altogether, those stocks in the industrial sector should do really well, and this one is going to continue to boost that dividend. Even against some weakness in the share price, the Chemours company has kept that commitment to its dividend, increasing it from just 3 cents a share to 25 cents a share over the last 5 years, an increase of 730% over the period. We'll get back to that list and the 3 warning signs you need to be watching for, but I want to get your opinion on this as well. I love those dividend growth stocks, but a lot of the best ones don't pay the highest yield. For example, our highest paying dividend stock still only pays 8% on the price. So let me know in the comments below, which do you prefer, that higher yield or the dividend growth that keeps the payout growing? Which is more important to you, the cash flow now or in the future? I actually had to look this next one up. Camping World Holdings, ticker CWH, is actually America's largest retailer of RVs and related services and pays an 8% dividend yield. The company has been serving RV consumers since 1966 through a network of dealers and service centers and has booked 14% annual revenue growth since 2016. And new vehicles make up about half the revenue, but it's also got a great source of that recurring revenue here with its services, finance, and insurance programs. The company controls a 20% market share of the RV market, a commanding lead in a market that's growing by 10% a year. Between retirements and the baby boomer generation and the trend to RV living with the younger generations, more than 11 million U.S. households now own an RV. And while the stock price has been volatile, dividend payments from CWH have increased steadily from just over 7 cents a share in 2017 to over 62 cents each for a 756% increase over the last 5 years. Now, I've actually got a bone to pick with this next one because even though it's a great company with a 3.8% dividend yield, whoever decided to call it NRG Energy needs to be shot. Now, seriously, when you include the ticker symbol on this one, which is also NRG, you end up saying energy, energy, energy. And when I say it, I half expect the CEO to appear behind me with a hacksaw or something. Now, all that aside, the company is one of the largest energy producers in the United States with over 6 million residential customers and 14 gigawatts of generation across electricity and natural gas. And even though it's an independent provider, it still operates in that protected, regulated market of electric and natural gas, so cash flows are extremely consistent. That's helped management commit to that constant dividend growth while still being able to grow the company and the share price as well. Now, the recent acquisition of Direct Energy is expected to produce over $300 million in savings and drive part of its strategic growth initiative, growing the dual fuels business and streamlining production. That should result in even stronger cash flow and higher dividends. Shares of NRG were paying a dividend of just 3 cents a share in 2017, but have increased that amount by more than 10 times to over 35 cents a share over the period. That's an annualized 63% increase. We're coming up on the top dividend stock for growing payments, one that has increased its payout by almost 1,600% in the past 5 years, but there is a huge warning here that you need to understand when you're looking at these dividend growth stocks. Nation, those prior increases do not guarantee a stock is going to keep raising its dividend. So there are 3 signals that you need to watch for to make sure those checks keep getting bigger. First, you need to assess why the dividend has increased so much in the past. What you'll find is a lot of times these might be on those big picture macroeconomic events that might not be repeatable in the future. If the price of oil surging to $100 a barrel is what really drove that increase in dividends, how likely is another increase if oil prices just stay at that point? You've also got those one-off events like spin-offs and asset sales that can artificially boost stock dividends. And this would be like when a company sells a part of the business or issued shares for a part of its business, like gets a big cash payment and then distributes some of that in a special dividend or just increases the regular dividend. Again, it's not going to be something that's going to be repeatable. Now, I've avoided most of this by screening for only those companies with those long-term consistent dividends, but be on the watch for this one. Something else you want to watch for is what's called the payout ratio, and this is one of the most important measures for dividend investors. The payout ratio is the amount paid to cover the dividend on a quarterly or annual basis divided by the total earnings per share. So what percentage of the profits are going to cover that dividend each year? And the payout ratio is important here because it's going to tell you one of 2 things about that stock, that dividends might be in danger or the company has room to grow those payouts. For that, you need to compare the payout ratio with similar companies, those in the same industry. Now, stocks with low payout ratios might be able to increase the amount of profits they pay out, increasing the dividend, or they're just holding more back for growth to boost that share price. And stocks with very high payout ratios, on the other hand, those could be in trouble. If earnings fall in a recession or even if profits flatline, you could be facing a slower growing dividend in the future, or even one in danger of being cut. Our next dividend growth stock posted the highest return in the S&P 500 last year, Dividend Energy, ticker DVN. Devon is a leading oil producer in 3 states, North Dakota, Texas, and Delaware. With oil spiking over the last 2 years, these assets have become cash flow machines, and like most oil companies, Devon is choosing to return the cash to shareholders rather than acquiring assets at higher prices. Free cash flow quadrupled since its merger with WPX last year, and it's forecasting even stronger cash flow this year. At $95 per barrel, well above the recent price, the company is going to grow free cash flow by 17% this year, and the price could fall to $30 a barrel before the company is operating at a loss. This all helped Devon recently increase its share buyback program to $1.6 billion, nearly triple what it bought back last year, and continue that history of dividend growth. Not only does Devon Energy pay a strong 6.9% dividend yield, but it's increased that from 6 cents a share to $1 a share in the last 5 years, an increase of nearly 1,600%. Click on the video to the right for how to invest $1,000 in dividends, a complete dividend portfolio for safety and cash flow, and one that pays 6 times the dividend versus the stock market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.